The Great Depression. The Great Depression was the most severe economic collapse of the 20th century, beginning in 1929 and lasting for over a decade. It started with the stock market crash in the United States, but the underlying problems had been building for years. During the 1920s, the economy appeared strong, and many people began investing heavily in stocks. However, much of this investment was fueled by borrowed money, creating a fragile system dependent on constantly rising prices. When stock prices began to fall in late 1929, panic quickly spread. Investors rushed to sell their shares, triggering a massive market collapse. As confidence disappeared, banks began to fail, partly because they had invested heavily in the market and partly because people rushed to withdraw their savings. Without access to money, businesses struggled to operate, leading to widespread closures and layoffs. Unemployment rose dramatically, with millions of people losing their jobs and homes. Demand for goods dropped sharply, causing prices to fall and businesses to cut production even further. This created a downward spiral known as deflation, where economic activity continues to shrink. The effects were not limited to the United States. Because of global trade and financial connections, the crisis spread to Europe and beyond, turning it into a worldwide depression. Governments struggled to respond, and recovery was slow, only improving significantly with increased government intervention and the onset of World War II. The 2008 financial crisis. The 2008 financial crisis was one of the most significant economic downturns since the Great Depression, and it originated in the housing market of the United States. In the years leading up to the crisis, banks and financial institutions began offering mortgages to a wide range of borrowers, including those with poor credit histories. These loans, known as subprime mortgages, carried high risk, but were widely distributed. Instead of holding on to these risky loans, banks bundled them together into complex financial products and sold them to investors around the world. These products were often rated as safe, despite being built on unstable foundations. As long as housing prices continued to rise, the system appeared to function normally. However, when housing prices began to fall, many homeowners found themselves unable to repay their loans. Defaults increased rapidly, and the value of mortgage-backed securities collapsed. Financial institutions that had invested heavily in these assets began to suffer massive losses. Confidence in the financial system quickly eroded. Major banks and institutions faced bankruptcy, and credit markets froze, making it difficult for businesses and individuals to borrow money. Governments were forced to intervene with large bailouts to stabilize the system. The crisis spread globally, leading to widespread job losses, declining economic activity, and a deep recession. It also exposed serious weaknesses in financial regulation and risk management. The 2008 crisis demonstrated how interconnected and complex financial systems can create hidden risks and how quickly those risks can trigger a global economic collapse. The dot-com bubble. The dot-com bubble was a period of rapid growth and sudden collapse in the technology sector during the late 1990s and early 2000s. It was driven by the rise of the internet, which created a wave of excitement around new online businesses. Investors believed that the internet would completely transform the economy, and they rushed to invest in companies that promised to be part of this digital future. Many of these companies, often referred to as dot-com companies, had little to no profit and in some cases, no clear business model at all. Despite this, their stock prices rose rapidly as demand for tech investments surged. Investors were not focused on fundamentals such as revenue or sustainability, but rather on growth potential and speculation. As more money entered the market, valuations became increasingly disconnected from reality. At its peak, the market was flooded with startups going public, attracting massive amounts of capital in a short period of time. However, as these companies struggled to generate actual profits, confidence began to weaken. Investors started to question whether these businesses could deliver on their promises. Once this shift in sentiment began, the bubble quickly burst. Stock prices fell sharply as investors rushed to sell. Many companies went bankrupt, and trillions of dollars in market value were lost. The collapse affected not only tech companies, but also the broader financial markets. Although devastating in the short term, the dot-com bubble left behind important infrastructure and innovations that would later support the growth of successful technology companies. The Asian financial crisis. The Asian financial crisis began in 1997 and quickly spread across several Southeast Asian economies, becoming one of the most significant regional economic collapses in modern history. It started in Thailand, where years of rapid economic growth had been supported by heavy borrowing and large inflows of foreign investment. Much of this capital was used in real estate and infrastructure projects, creating an economic environment that appeared strong but was increasingly unstable beneath the surface. A key issue was the fixed exchange rate system. Many countries in the region had tied their currencies to the US dollar, which initially helped maintain stability and attract foreign investors. However, as economic imbalances grew, these fixed rates became difficult to sustain. Investors began to lose confidence in Thailand's ability to maintain its currency value. In July 1997, Thailand was forced to abandon its fixed exchange rate, leading to a sharp devaluation of its currency. This triggered panic among investors, who quickly withdrew capital from other countries in the region, fearing similar collapses. As money flowed out, currencies across Southeast Asia fell dramatically in value. The consequences were severe. Businesses that had borrowed in foreign currencies suddenly faced much higher repayment costs. Many were unable to meet their obligations, leading to widespread bankruptcies. Banks struggled under the weight of bad loans, and financial systems across the region weakened rapidly. The crisis spread to countries such as Indonesia, South Korea, and Malaysia, causing deep recessions, rising unemployment, and social unrest. Governments were forced to seek assistance from international institutions like the International Monetary Fund, which imposed strict economic reforms in exchange for financial support. The 1973 oil crisis. The 1973 oil crisis was a turning point in global economic history, showing how deeply modern economies depended on energy. It began during a period of geopolitical tension in the Middle East, when members of the Organization of Petroleum Exporting Countries, or OPEC, decided to reduce oil production and impose an embargo on nations that supported Israel during the Yom Kippur War. This sudden restriction of supply sent shockwaves through the global economy. At the time, many industrialized countries relied heavily on imported oil to power transportation, manufacturing, and electricity. When supply dropped, prices rose rapidly. Within a short period, the cost of oil nearly quadrupled. This sharp increase made energy significantly more expensive, affecting almost every sector of the economy. Businesses faced higher production costs, which were often passed on to consumers in the form of rising prices. This led to inflation, where the general cost of goods and services increases. At the same time, economic growth slowed, creating a rare and difficult situation known as stagflation, where high inflation and low growth occur together. Governments struggled to respond. Some introduced fuel rationing, reduced speed limits, and encouraged energy conservation. Long lines formed at gas stations, and shortages became common. The crisis exposed how vulnerable economies were to external supply shocks, especially when tied to a single critical resource. The effects of the oil crisis were long-lasting. It forced countries to rethink their energy policies, invest in alternative sources, and improve efficiency. It also shifted global economic power toward oil-producing nations. The COVID-19 economic crisis. The COVID-19 economic crisis began in 2020 and was unlike most previous downturns, as it was triggered not by financial systems or market imbalances, but by a global health emergency. When the pandemic spread rapidly across countries, governments were forced to take drastic measures to contain it. Lockdowns were implemented, travel was restricted, and many businesses were required to shut down temporarily or operate at limited capacity. This sudden halt in economic activity created immediate disruption. Entire industries, particularly tourism, hospitality, and aviation, experienced sharp declines in demand. Businesses lost revenue, supply chains were interrupted, and millions of workers were either laid off or faced reduced income. Unlike traditional recessions, where demand gradually weakens, this crisis was characterized by an abrupt stop in both supply and demand at the same time. Financial markets reacted quickly, with sharp declines reflecting uncertainty about how long the disruption would last. Governments and central banks responded with unprecedented levels of intervention. Massive stimulus packages were introduced to support businesses and households, while central banks lowered interest rates and injected liquidity into financial systems to maintain stability. Despite these efforts, the effects were widespread. Small businesses struggled to survive, inequality increased, and many economies contracted at record rates. At the same time, certain sectors such as technology and e-commerce experienced rapid growth due to changes in consumer behavior. As restrictions were gradually lifted, recovery began, but it was uneven across countries and industries. The crisis also led to long-term shifts in how people work, consume, and interact.